Hello. It looks like we are going to start today's evening streaming, and I already see that there is a connection to the file. Let Okay, it looks like we are finally live, and hopefully the again that happened again. I was on every testing stream which I tested over last several hours. The video quality was quite good, and now it is low quality again. Okay, I opened YouTube, and it looks like the text is readable and the quality is not that bad. So I welcome everyone. Thanks for joining in, and today we are going to begin with a Q&A. I actually should edit the title. Q&A. Is the sound okay? If someone is watching, let me know if sound is okay and if picture is okay. And I will start with answering the question from the question file. I received a question about the situation of a person who came to United States with previous background is bookkeeping in her country. It's a Russian speaking country, so she has a background in bookkeeping, and she also has intermediate level of English language, so she is learning the language, and she is asking for advice what would be the best way to start doing bookkeeping in her situation. And there is probably not enough details to provide a complete answer, but I would offer a few ways to make situation better. First of all, you need to expose yourself to some English speaking environment to work on and further improve your oral and written English skills, because in United States it is quite important to have pretty good English speaking and written English skills to be a bookkeeper. You can select some entry-level positions, probably not related to bookkeeping, but ones which will require some level of communication from you. You can ask probably you can search for some Russian companies doing business in United States, Russian or Ukrainian, or whoever speaks your native language. You can check if they need any kind of workers in the United States where you will be able to kind of work and improve your language skills. Alternatively, you can search for Russian speaking or Ukrainian speaking or your native language speaking CPAs in United States who own their accounting business and who might already serve some Russian clients or the ones who speak in your native language. And you might want to ask that person if they need any kind of assistance on any kind of conditions. I don't know your situations exactly. I don't know if you currently work on some unrelated to accounting job or if you currently work on some accounting related job. So first task is to expose yourself to some I would say business English. You can do that through employment, or you can do that through some volunteering job, or you can just go to some ESL courses and enroll yourself in any available free online courses related to business and bookkeeping and English language. And you need to come to the point where you are able to do some accounting report or write an email to a client and use some English there. And at that point, you will be kind of ready to apply the entry-level positions in accounting and bookkeeping. And then, when to apply to the entry-level positions, you will need to learn some technical accounting skills like QuickBooks certification. You may want to obtain some education, basic accounting education through your community college, which is free and which will also help you with English and business English and accounting itself. And you might also want to check if your foreign education, if your foreign diploma, if you have a master's diploma in accounting from your country, from Russia or from Ukraine, it is highly likely that you will be able to get your diplomas evaluated for CPA, and you will be eligible to take CPA exam. I am not saying that you need to put all your efforts into getting a CPA, but if you do, you need to have several years of experience before taking CPA exam, and the CPA exam will give you like a key to higher paying careers. But at the beginning, if you just move from another country, if you still work on your English, you need to expose yourself as much as possible to English speaking environment and some written English, some business English through courses, job if possible, your community college, ESL courses. There are many alternatives. I advise you to go to your native language community in USA. Like in Russian, it will be «Ищу совета США» or «Помогаем нашим», and ask questions there where you can get some exposure to English language, or where you can get some accounting courses or English courses. And 99% that you will be able to get all of that for free. Okay, so far we got only one question, so I will start with a recap of today's lecture in the morning. Please let me know if audio quality or video quality has any issues, so I can try to resolve it. And now I'm moving to MIT lecture portal. I am sending a link here in comments for that, and I am actually going to look at lecture 1. I am also sending a link to the lecture 1 if you have Any problems opening it? So it's just introductory lecture. It has information about professor who is running accounting and school information. So that is School of Management, which is pretty reputable school. The not so good part is that it is 2004, pretty old, but it is still actual for most of the parts, except for revenue and leases. These accounting standards were pretty much rehauled several years ago, but when we come there, we will study the updated versions. So let's see what they have there. Discussion is accounting, why it's interesting, why do we need accounting, sophisticated. So the course objective is to create sophisticated financial statements user, and I think we already kind of answered to these questions, but let's see what MIT has to say on that matter. They recommend a book here and some administrative MIT information which is not relevant for us. Okay, page 4, not relevant. Let's see. Okay, the video quality should be more or less okay. Hopefully you are able to see everything. Let me know if quality sucks. That's their course grading. Okay, let's go. Why do we need accounting? So financial accounting provides information to people outside of the company. So basically they are breaking down accounting into 3 components here. Financial accounting for outside users, managerial accounting for internal users like top management, and tax accounting, accounting for tax payments. Usually, so accountants mostly deal with financial accounting, and managerial accounting is something based on financial accounting with some minor adjustments, like coming from net profit to EBITDA, because EBITDA is like a non-accounting measure. It is like non-GAAP measure. But managerial accounting might have some other adjustments too. So what do we say about financial accounting? It provides information primarily to people outside the company. It provides information that would be helpful in attracting capital, equity and debt, credit from suppliers, customers, employees. So everyone inside the company and its counterparties in the business wants to know entities' financial position and entities' kind of credit information, credit quality. What does managerial accounting do? It helps to make internal investment decision and evaluate performance of management and of employees. And tax accounting provides information to the tax authorities. I don't think there might be any questions about that, but if you do have a question, feel free to ask it in the chat or in the Q&A document. It's pretty easy. You might be asked about these 3 types of accounting on your entry-level accounting interview. I remember being asked about that many years ago. Just if you are a fresh student, they will probably ask how good you learned accounting, and you just need to learn these 3 types of accountings here. Okay, why do we need? We need accounting to inform internal and external users of the financial information about financial position of the company. That pretty much repeats the information of the previous slides. Nature of financial accounting information. So it should help making investing and credit decision for someone who has understanding of the business. So it's a presentation to potential investors, to creditors, to other users, and it provides information about economic resources and the claims to those resources and changes in them. So basically that information, if you remember a lecture in today's morning, they speak about the balance sheet here. On one side you have assets, on the other side you have equity and liabilities. And assets are like economic resources of the company. It's source of future economic benefits, while the liabilities are a source of future outflow of economic benefits. It's what entity owes, and it owes those money because it's used those funds to acquire its assets. Okay, let's move on. Here they demonstrate how important the earnings are and how can it is hard not to underestimate the accounting part of the business when business reports its earnings. You can see that's Walmart company. Back then it was like $50 a share. Now I believe it's like 200 or 300. It was not. Amazon was better investment over that time horizon. It was probably $6 back then. I don't know if they did any splits, but now Amazon is like 3,000. So you see, when Walmart announced its earnings 18 years ago, almost 18 years, on November 13, its share dropped like pretty significantly, like for 5% or something. So accounting is important. I don't think we can argue much about that. It's just important. Financial accounting, course objective, sophisticated financial statement user. Let's see if they give us a definition for sophisticated user, but first they want to tell us what the objectives of the course are. To become intelligent users of accounting information, be comfortable looking through an annual report, learn the language and techniques, begin to develop the ability to use financial statements to assess a company performance, have a sense of the limitations of financial statement data. What are not our objectives? To train you to be an accountant or bookkeeper, and financial statement analysis. So for these lectures, they do not want you to train to be an accountant or bookkeeper. However, when you learn how to do entries and when you learn an accounting standards, and all of that is part of that course, you will acquire the skill which any accountant or bookkeeper need. So you will not be like a job-ready accountant or bookkeeper after the course, but you will acquire a great chunk of knowledge to become that. That's what the aim of MIT. And if we combine what they have in the MIT lectures with what I give you and with QuickBooks certification, I believe in some circumstances that will be enough knowledge to get some entry-level position at some small accounting firm. You will still need to make your own path to the top and to progress in your career. But when you get theoretical knowledge of accounting and practical and some bookkeeping practical from QuickBooks courses, and you do some practice on your own, and you, assuming you are a good student and you study everything, then I think that should be enough to start to apply for the jobs and to close any educational skill gaps you have for the entry positions. Okay, let's proceed. sophisticated financial statements users. Events are occurrences that affect the firm. Microsoft sued by Justice Department. It was a big deal back in early 2000. That was some anti-monopoly cases related to bundling of Windows with other products. Internet Explorer owned the internet back then. It was like 90% share, and Microsoft lost it all to Google Chrome. McDonald's sells hamburgers. United Airlines workers go on strike. The Gap announces a new marketing strategy for its own. So when all of that happens, it is expected that these events have some impacts on financial statements, and they have impacts on earnings. And when that information is announced, it will have an impact on the share price. And you know that we all more or less depend on the prices of shares if we have any savings which are investment in stocks. So okay, so there are events and actions, and those events and actions they impact management choices, and they also go through accounting rules. And based on accounting rules, their impact on financial statements is determined. And that is the way that all situation is processed from the event to an accounting entry. Let's see. So rules. The main rules in accounting are generally accepted accounting principles, GAAP, and that financial accounting translates events into financial statements. And management generally accepted accounting principles are not kind of strict rules, they are principles. So it is possible that some event can impact or can be impacted by several different accounting principles, and accountant judgments will be required to treat that event either as, for example, loss, as expense, or as a capitalized expense. In the morning lecture, we can remember we had a situation where we paid a trucking company to deliver equipment to our site, which we will put into operation. So we have to decide whether that equipment, whether that is an expense, we just paid money to the trucker, we should expense that probably, or whether we need to add that value to the equipment. And based on GAAP, the right answer is to add that value to equipment. So that's how important GAAP is. In Europe, companies mostly use IFRS, International Financial Reporting Standards. In United States, it's US GAAP. 3 keys to becoming a sophisticated financial statement user. The first one is understand the rules and management discretion. Second one is understand what explains the rules and the type of management discretion, incentives. And the third one, understand how events affect firm value. So let's dig in a bit here. So the rules are GAAP rules, and management discretion, it's the power that management have to apply GAAP rules. It is always some gap between the most conservative treatment of any transaction and the most aggressive treatment of any transaction. And some management wants to be in the middle, some wants to be conservative, some wants to be aggressive, and oftentimes all 3 options are possible and within the standards. So you need to understand why and when management wants to be conservative and when management wants to be aggressive. And MIT gives you an answer, because management have an incentives, they have bonuses They have salaries. They want their company to continue as a going concern, as a successful business. So that determines how they treat the transaction. And last point, understand how events impact firm value. That's where is that chart? Okay, here. So I believe we understand that if some significant negative event happens, firm value will be affected by it. The stock can lose several percentage points. Will we be able to forecast that? Probably no. Okay, let's see where I did stop. Okay. Why is accounting interesting? It's a very good question. Why is accounting interesting? And they say, MIT says that it's diversity of business and events, many different players, diverse incentives, uncertainty, many regulations. So I would say it's not only interesting. It can be quite complicated sometimes because of these matters. Hi everyone, I see we have several people online. Let me know if sound is bad or video quality is bad, or ask any questions. If you have any questions to the MIT materials or to myself. Today is Q&A session mostly, but because I see we don't have a lot of questions, I decided to run MIT lectures so far because we didn't have enough time to go through them on the morning session. I'm doing that right now. So let's get back to the slides. Overview of financial information. Okay. If you ever trade stocks or invested in the stocks in the United States, you know that with some cycle, the company reports different set of financial statements. When they report annual report, audited annual report, that's Form 10K. If company runs a calendar year, they usually report within 45. Some entities report within, I believe, 45 days. Some report 60 days after the year end, and some might report even later than that. They also report unaudited quarterly reports. It's also like a 30 or 45 days after the quarter end. And they have current reports, which they report 10 days of the end of the month when they have a significant event. 8K. If you see an unaudited word here, it is not kind of unaudited. It's reviewed by auditors. That means that, like, if you see audited, that means that independent auditor verified the financial report with audit procedures. And unaudited means that audit still reviewed the report, but the quality of that review was less severe than compared to the audit. So auditors still take a look at the quarterly reports. And we have foreign companies which report on 20F. So we have a bunch of foreign companies listed in United States, and many of them are like Chinese or some European companies which are listed on New York Stock Exchange, and they report 20F. Annual report. Annual report has the following components. It's the management letter, the financial statements, and the auditor's report. Management letter is like a verbiage, like discussion on developments during the year and current state of the company. And the financial statements is actually like a balance sheet, income statement, statement of cash flows, equity statement, and notes to the financial statement. And the auditor's report is a 1 or 2 page report which says which procedures did auditors perform and whether they found any material misstatements in the company. Auditor's report in United States should be in accordance with generally accepted audit standards. And the audit opinion, which is included in the auditor's report, will say that financial statements present fairly in all material respects the financial position of the company and whether it is in conformity with GAAP. Okay, we have some list of responsibilities here. I will not go through that. It is a bit outside of my scope. You can do that as part of your self-study and homework. It's just pretty boring, I would say. And if you are at an entry level into the profession, it's a bit too early to know about that. But if you invest in stocks, it might be a bit of an interest for you. Okay, financial statements. They contain historical information. And we have balance sheet, income statement, statement of retained earnings, statement of cash flows, and footnotes. Balance sheet. We have a definition of a balance sheet here, which says that it is statement of the financial position of a business as of a certain date. So it provides that statement provides a snapshot of the assets, liabilities, and equity of the company at a certain day. It's usually end of the year or end of the quarter, like December 31st, 2020. It has assets on one side, and from the morning lecture you remember that assets is something that we own and something which will generate future economic benefits for our company. And they list cash, accounts receivable, equipment, land there. Liabilities is something that we owe to the third parties, like loan payable, accounts payable, customer advances. So liability is a future outflow of economic benefits. And equity is initial investment plus the sum of undistributed profits. We covered that in the morning as well. Income statement. So if you see balance sheet provides a snapshot as of some date, December 31st, 2020. That's the snapshot of the balance sheet. And also balance sheet. So as of that day, balance sheet provides you with information of what assets you have accumulated from the first day of the business till your reporting date. So it's like a cumulative or permanent account. So you always accumulate something on the balance sheet. While income statement is a periodical account. So it shows you something which happened over a period of time. And for annual financial statement, that will be 12 months before the end of the year. Like if the reporting date is December 31st, then the annual report will be for 12 months for the year 2020. And if it's a quarterly report, then you will usually have 3 months in that report, and you also might have year-to-date information in that report. Like if it's the reporting date is September 30, 2020, which is 9 months, you will have income statement for 3 months for the third quarter and cumulative for the 9 months. Expenses. So we have revenues, measure of economic benefits generated by the sale of product or providing of services over a period of time. And we have expenses, a measure of economic sacrifices incurred to earn the revenues in a given period. So revenues is what we earn and expenses is what we incurred to earn the revenues. Examples. So for revenue, it's we got cash for the sale of products, or we sold services and got accounts receivable like a future cash. And for expenses, we got when we sold an inventory, we need to write off the cost of inventory sold. We did an entry like that in the morning session. Salaries to employees, rent, electricity, advertising, and net income is just revenues minus expenses. Dividends. So dividend is an equity account, and we didn't cover dividend in the morning section. It's actually a bit of advanced accounting already, maybe too early to learn for us, but what are dividends paid to owners considered an expense? Owners are residual claimants. Dividends are distribution to the owners out of the profits earned by the business. In determining accounting profits to the residual owners, we only subtract the cost of all factors of production. Dividends are not a factor of production. Okay, so the short answer, I don't know, they give you a lot of details here, and these details make sense, but if you are just a starter in accounting, the answer is that dividends are deducted from retained earnings, which means they are deducted from equity, and they do not go through income statement. So dividends reduce your equity directly. And for example, if you want to make an entry for the dividends, for example, you paid $10,000 cash in dividends to the owners of the company. You will credit cash, $10,000, cash decreased, asset decreased, credit $10,000, and you will debit equity. You will debit retained earnings account within the equity. Debit $10,000 equity equity accounts, that equity decreases, so it's a debit. Financial statements, retained earnings, and shareholders' equity. That's also complicated stuff. You can read that. I don't think I need to reread it for you. So retained earnings, basically like accumulated profits of the company, reduced by the amount of the dividends withdrawn by the owners. And statement of shareholders' equity describes all the movements in the equity for the company. And here is the summary of the lecture. We did the first lecture and we did it in almost 40 minutes. That's good result. We have 30 pages and we spent almost 30 minutes on it, so 1 minute for a page. Not bad. Now I will open lecture 4. Lecture 2. Lecture 2, balance sheet. We didn't quite cover balance sheet yet in the morning session. So we go through that, and we will learn something new about balance sheet. Residual administrative. Okay, we don't need residual administrative matters. It's a good question here. Do private companies file with the SEC? Public companies file, but what about private companies? They only file their financials if they have public debt outstanding. So a private company is the one which doesn't have shares listed publicly, but it can have a debt listed publicly. So in that case, they file financials. For example, I work for a private company which doesn't have any public debt. That is why we do not file any financial statements publicly. Financial statements, the annual report. Again, that is kind of a repetition of the previous lecture. I will skip it. Assets. That is something we covered this morning in the lecture. Probable future economic benefits obtained or controlled by a particular entity as a result of past transactions or events. So it's basically one more definition of the assets. It's something that we know and something which can bring us future economic benefits. They also add that we kind of control it, which is a synonym for own, and they also mention past transactions or events, which is kind of a good note just to know. The specific types of assets a firm owns depends on the nature of its business. Manufacturing versus merchandising versus financial versus service. So yeah, your types of assets and types of accounts you will use will depend on the nature of the business. I would assume that's an obvious fact. Okay, let's see. Current assets. Okay, they don't start with non-current, they start with current. Cash and other assets that are reasonably expected to be realized in cash or consumed during the normal operating cycle of the business or within 1 year. So that's not only cash, that's also other assets. Cash and cash equivalents, short-term investment, accounts receivable, inventory, prepaid expenses. If you are new to accounting, I advise you to use every opportunity to kind of try to learn by heart what sub-accounts are included into the assets or current assets. So assets can be broken down into current assets and non-current assets. And currently we look at the current assets. So cash. And they also have notes related to valuation of those assets on the company balance sheet. Like they say, okay, if you have short-term investment, you should probably value it at the market value. If it's, for example, investment in the stock. If it's accounts receivable, you need to value it at the net realizable value, which is like its nominal value less the provision. If it's inventory, you need to look at the lower of historical cost or market value. And currently it is net realizable value of inventory. I don't think replacement cost still works, but we will go over inventory accounting in the future. Prepaid expenses is when you issue a prepayment to some counterparty. And here they describe you the business side of the deal. The business side of the deal is you have to wait quite a bit from the moment you buy raw materials till the moment you produce inventory, sellable inventory. When you transform raw materials to finished goods, then you sell it and you got accounts receivable cycle. And after you sell it, you also need to wait until your counterparty pays you. So a cash collection here. So that is called an operating cycle of the entity. Long-term investments. Okay, so that's probably related to the non-current assets. Investment intended to be held for a period of time usually extending beyond 1 year. Debt and equity securities such as stocks, bonds, and long-term notes receivable. Tangible assets not currently used in operations, like land held for investment purposes. So that's good that they give us that account, but if we are talking about entry-level accounting and bookkeeping positions, I don't think you will be dealing a lot with long-term investments. Property, plant and equipment. That account is more interesting for us because almost every business have some kind of a property, plant and equipment. So what's the definition? It's the assets of a durable nature that are to be used in the production or sale of goods or rendering of services rather than being held for sale. Machinery, factory, building, etc. When you buy an equipment, you recognize it on the books at the cost. Remember our situation with the delivery of the equipment to the site? When you pay for the delivery separately, you also recognize it as an asset on your cost as part of the capitalized cost of that equipment. And on your books, you carry the equipment at cost and you deduct accumulated depreciation from the cost of your equipment. If you know what is depreciation, good for you. For others, you need to know if you use equipment, any equipment in your business, you should depreciate that equipment. And depreciation means that over time, that equipment loses its value, and speaking on a business language, that value lost is transferred to the products produced. So you kind of transfer depreciation from your assets to the inventory you produce or to the cost of sales. Let's say you do a services and you own some equipment and you depreciate it. Like, let's say you have a 30,000 item and you depreciate it over 3 years. So every year of those 3 years, you will debit depreciation expense for 10,000, and then you will credit accumulated depreciation for 10,000. And that accumulated depreciation is a contra asset account, which I think we'll cover in one of the future lectures. It's the one which I said is exception. If you remember that file here, here I have accumulated depreciation. It's red. It increases by credit. And it offsets on the face of the balance sheet. It usually offsets the value of property, plant and equipment. Okay, let's go back to our file. And property, plant and equipment is usually abbreviated to PP&E or PPE, like a personal protection equipment. And one of that PPE is land on which the company conducts its operations. And land, if you own the land, it is not depreciated because it is kind of doesn't lose value because of your production. Intangible assets, they give you more and more complicated material. So it's non-current, non-physical assets of business, the possession of which provides uncertain future benefits to the owner. Goodwill, trademarks, patents, copyrights, etc. Is accounts receivable and intangible assets? Not for accounting purposes. So on a common sense, you can say, okay, accounts receivable might be an intangible assets. You cannot touch it with your hands. But for accounting purposes, it's a tangible and it's usually a current asset. Intangible assets are carried on the balance sheet at a cost less accumulated amortization. So the only difference with PP&E is that PP&E have depreciation and intangible assets have amortization, and everything else is basically the same. Cost is whatever you paid to acquire. Okay, we have liabilities here and probable future economic sacrifices arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or event. So they give you even more complicated definition of a liability. But in essence, it's the same as to say that it is a currently owed amount which will result in future outflow of economic benefits. And so in that case, the economic benefits is the same as to say transfer assets or provide services. So if you owe someone money, it's a liability. If you own someone some other asset, like your land or intangible assets, it's also a liability. Or if you owe someone some services, it's also a liability. Like if you get a prepayment for your service, but you haven't rendered your services yet to that person, that will be a liability. Current liabilities usually includes accounts payable, wages payable, and current portion of long-term debts. And long-term liabilities, obligations usually expected to require payment over a period of time beyond 1 year. And financing obligations arising from an issuance of bonds, long-term notes. So it's basically long-term liabilities of different nature, liabilities from debt instruments, bonds, long-term notes, and mortgages, and the maturity date, the rate of interest, and any security pledged to support the borrowing agreement should be clearly shown. So if you have a mortgage, or if you have any collateral to that debt, you also need to present that on the financial statements. And the last component of the balance sheet is owner's equity, which by MIT definition is the residual interest in the assets that remain after deducting the liabilities. So assets minus liabilities, what is what they say. And if we move a bit further, the equity consists of contributed capital by owners, and we have different classes of capital: common stock, preferred stock, and we also have a retained earnings, which is accumulated profits in the entity. And retained earnings is equal to cumulative sum of profits earned from the inception of business minus cumulative sum of all dividends distributed to the owners from the inception of the business. I see some people are leaving out the translation, and we are running out of time. I planned 1 hour Q&A session. Let me check if we have any questions so far. Okay, no additional questions, and no questions for the MIT materials. And for those people who still stay on the translation, I want to remind you that at the end of that second lecture notes, you will have a list of operations, and it's called page 42. It's called homework problem. I will be sending out an email, and a part of that email will be to reflect these problems in the your homework file, which we considered how to set up in the morning session. So let's go here. We have homework public folder. In the course folder, we have homework public folder, and I already created my own file here. You can basically just copy it. Make a copy. Okay, and you can rename it with the name of your team and your first last name or your alias if you don't want to use your personal name, and you go to transaction list and you just continue to reflect these entries here, like for example issue of 50,000 cash. So you start here and you figure out what's the debit, what's the credit. Debit is obviously cash, credit is obviously equity. We covered that, and it will be 500,000, and that will be 500,000 too. Okay, let's go back here. Okay, I did a reminder on the lecture. Let's see if I finished with the equity statement. Long-term liabilities, stockholders' equity, retained earnings. Do you have any questions about course content or something? Were you able to take a look at the morning sessions? I apologize for the poor quality of the morning sessions, resulted from some internet connection being not very best and some streaming software which was more complicated than my skill dealing with it. So let's see. Retained, okay, residual interest in the assets after deducting the liabilities. We covered that. Retained earnings, a measure of undistributed profits of a business, and capital contributed by the owners should not be included into retained earnings because it should be included into the contributed capital. It's a cumulative sum of profits earned from the inception of the business minus cumulative sum of dividends. We already covered that a couple of times. Oh, I see people are coming back to translation. Can anyone give me any sign? Any question? How does retained earnings change over a period of time? So every year you start with a beginning balance in retained earnings. You add whatever you earn during the period, then you subtract dividends during the period, and you got the ending balance. And we came to accounting equation, which we covered in the morning section. Assets equal liabilities plus owner's equity. And accounting equation is basically a balance sheet equation, and balance sheet is just a visual representation of accounting equation. So what do we have here? What type of an account? Identify assets, liabilities, equity. Okay, equipment, assets, retained earnings, equity, patent, asset, intangible assets, common stock, equity, dividend payable. That's the tough one. So we already discussed all that accounts, but what about dividend payable? And dividend payable is actually a liability account. When you declare a dividend but do not pay it with cash yet, but when you haven't paid it with cash yet, but you already declared it, you need to debit your equity, reduce your equity, and credit dividend payable. Increase your liability. And when you pay dividend payable, that will be the moment when you credit cash, you pay dividend, assuming you pay dividend with cash. Credit cash, debit dividend payable. So dividend payable is a liability account. Accumulated depreciation. So that's also an interesting one. if you remember from our transactions, accumulated depreciation on the balance sheet is shown within the assets, but it has properties of a liability account. It increases with credits and it decreases with debits. And we call it contra asset account. Okay, prepaid expense. Prepaid expense, so if we prepaid something, we gave money for someone to provide us some services which will be future expense for us, and that is an asset. We can demand our money back, or we can demand services in return for that money, so we will kind of get a future economic benefits from it, so that is an asset. Supplies inventory, assets, accounts receivable, assets, land, assets, goodwill developed by firm. That's a tricky one, because you usually do not recognize internally generated goodwill. You only recognize goodwill when you bought another company with that kind of goodwill. It's a complicated asset, and I don't think we will touch it over the course. If you are interested, you can investigate that by yourself. Unsettled damage suit. That's a tricky one too, because at some times, so you need, in order to recognize a liability here, you need to know the amount of damage, and you need to be able to estimate the amount of damage, which most of the time you can do. And you also need to estimate the probability of win or loss. And if there is I forgot the definition, but if it's pretty much significant probability to lose the suit and be liable for that damage, then you need to recognize a liability. Let's do a quick research. Liability recognition criteria. A liability is recognized on the balance sheet when it is probable that an outflow of resources. So they say that it is probable, and assets. And for assets they also say that it is probable. But I believe that for a liability, it should be yeah, I cannot find it fast enough. So percentage wise, it's usually like you recognize the liability. So if it's more than 50%, you definitely recognize the liability. I will research that topic and I will come back to it later. I will put it in my notes. Liability versus asset recognition criteria. Okay, let's go back to business. So this one, factory asset, increase in value of land. It depends of what land it is, because if it's land where we conduct our operations, we do not usually recognize, we keep it at cost. And if it's a land which we keep for investment purposes, it might need an adjustment due to that increase in land. Employee payroll taxes payable. Payable, then we can say that's a liability. Should we recognize the assets? Assets arise from transactions and events. A firm issues 12 million check to an insurance company for liability insurance over the next year. Yeah, that's an asset because we will use those 12 million over the whole next year, and we will need to allocate this money to the expenses ratably when we get the respective services. We cannot expend that amount in the moment when we issued that check. A firm issues a check for 500,000 as a deposit on a custom-built machine. That's a prepayment for fixed asset. Yeah, that's an asset. A firm buys stocks in another firm for 300k. That's an asset too, an investment. A firm acquires chemicals to be used as raw materials for 800k. That's an inventory. A well-known scientist is hired to manage the R&D function for 480,000 a year. Employment starts next month. This one is complicated. I'm not ready to give you an answer yet. Usually, when it is a research, it is expensed. And when it is development, you can capitalize something in some circumstances. But let's take it as a note for future consideration. The firm receives an order for 15,000 in products. If it's still an order and we haven't shipped anything yet and we haven't received the money, nothing will be reflected in the financial statements. The firm writes a check for 1 million to obtain an option to purchase a tract of land. Option is an asset. A firm received notice from suppliers that it has shipped raw materials of 200,000. The firm has title to the goods while in transit. So if the firm gets the title to the goods, if the transfer of ownership occurred, then the firm should recognize that as an expense. So they will debit, not an expense, they will debit the inventory credit accounts payable. A patent, it's an intangible asset. Debit, patent 1.2 million, credit cash 1.2 million. Liabilities. The firm owes its attorneys 50k in legal expenses. That's on the balance sheet as accounts payable, 50,000. Warranties on the products. Warranties is a complicated topic, and usually you recognize your warranty liability when you sell a product with warranty. So you will have a warranty liability on your balance sheet. Borrows 60k from the bank for a 90-day period. That's a debt, bank loan, short-term bank loan, because less than 12 months. Accounting transactions. We covered that topic. I suggest you do your homework and read about accounting transaction on your own. Okay, it has some examples of the accounting equation. And I also suggest that you do that as a part of the homework, just to repeat and obtain a better understanding of the exercises which we did back in the morning for that sessions. It's pretty nice presentation. So we contributed cash to the company. We get 10,000 for cash, 10,000 for capital. If you note, here they present increasing equity and liabilities with a plus. That's a different approach, but I advise you to learn both approaches. They also recognize some accounts payable, they pay for some equipment, and they do Like a revenue partially settled by cash. That's nice. Okay, expenses. Yeah, that's a good exercise for the homework. I believe we ran out of time for a bit, and that will be a good piece of the work to do on your own. Let's see if they have anything interesting. Okay, they have pretty wide accounting equation example here, and they also do a cash flow statement here, which is probably a bit outside of the scope of the lecture. And the summary. So for the next lecture, we will probably start next lecture with a recap related to the accounting equation, and we can use that materials for recap just for those who will not do much of a homework. And if you did the homework, you can be a bit late for the next lecture, because we do a recap for that. I'm going to conclude today's lecture. Please, because it's already late today, if you have any questions left, please submit them to the Excel file, to the spreadsheet file, to the Q&A file. I will share the link right now to the chat. I'm sharing that link. Put your questions there. Next Q&A session will be 9 p.m. Wednesday. We will, on that next session, we will do short recap. We will discuss the homework, which I will send in email tomorrow. And you will ask questions, I will answer. We will go through some other MIT notes or some other materials. Thank you. Have a great night. Have a great Sunday tomorrow. Thank you for spending your time listening to my accounting course. I hope that was a good investment of your time and you learned something new today. If you still think that you need more understanding, leave a question, say that